The queue outside the bank branch forms before sunrise, and no one speaks louder than a whisper, because uncertainty carries its own etiquette. Inside, employees count bundles of currency that technically remain legal tender. Yet every person in line senses that the paper in their hands is losing meaning faster than the doors can open. Scenes like this are usually archived as distant history, but their structure is not confined to any one decade or country. Whenever confidence in stored money weakens, the behavior repeats with minor variations. And modern financial systems contain pressures that echo those earlier moments, even when daily life appears stable. Present conditions do not resemble a visible bank run. Yet the architecture of savings has quietly shifted toward a similar vulnerability. Large pools of personal wealth now sit in instruments that promise stability while depending on mechanisms that gradually erode purchasing power. A tension that rarely announces itself as a crisis. This investigation examines what tends to survive when stored value is exposed to that slow erosion. Rather than predicting collapse, the analysis traces how certain categories of assets historically respond when cash ceases to function as a reliable container of time. To navigate that question, a simple framework is necessary, although its simplicity hides uncomfortable implications. Any store of value can be viewed as a contract between present effort and future access. And the durability of that contract depends on how the surrounding system treats delayed claims. During the inflationary cycles of the 1970s, households discovered that nominal balances could rise while real access to goods narrowed, a contradiction that unsettled traditional saving habits. What mattered was not the printed figure on an account statement, but the system's capacity to preserve purchasing power across time, which proved uneven and politically constrained. That episode reveals a mechanism that extends beyond its historical setting. When currency supply expands faster than productive capacity, the unit used to measure savings stretches, and assets tethered too closely to that unit inherit its instability. Modern parallels appear in prolonged periods of low interest rates where cash yields remain below measured inflation, quietly transferring value from savers to borrowers. Even so, describing this as a simple theft would ignore the policy trade-offs involved, since such environments also aim to stabilize employment and credit markets. A more precise interpretation treats purchasing power as a moving target shaped by institutional incentives. Central banks manage liquidity to smooth economic cycles, yet their tools inevitably redistribute the timeline of value, favoring present activity over distant claims. Within this framework, saving in pure cash becomes less a neutral act and more a bet on policy continuity. That framing may sound overstated at first, but it follows from observing that money itself is an administered asset whose characteristics change with governance. The channel approaches these dynamics as financial forensics, studying past system failures to understand what survives. Each historical case functions less as a warning than as a laboratory, where the interaction between currency design and asset resilience becomes visible. What emerges from those laboratories is not a universal rule, but a pattern of conditional outcomes. Certain assets maintain relative stability when cash weakens, although their performance depends on specific channels through which inflation transmits into the broader economy. Understanding those channels requires separating nominal stability from real preservation. An account balance can remain perfectly intact in accounting terms while its claim on future resources, contracts, and that divergence defines the core risk faced by passive savers. From this point forward, the analysis follows the contract framework through several asset categories that historically mediate that divergence. Each category illustrates a different way in which value negotiates with monetary systems, and none operates without limits that complicate simple prescriptions. Among tangible assets, productive land historically functions as a buffer because it converts monetary claims into biological output. During the hyperinflation of Weimar Germany, agricultural property retained exchange power not through price appreciation alone, but through its capacity to generate food, which households valued independently of currency fluctuations. That resilience emerges from a mechanism tied to necessity rather than speculation. Land capable of producing staples anchors value in recurring demand. Yet, its protection is conditional because political intervention, taxation, or supply shocks can interrupt the translation from output to security. Recent decades show a quieter version of the same dynamic in regions where farmland prices track long inflation cycles. Investors treat acreage as a hedge against currency dilution. Although the strategy falters when credit conditions tighten and leveraged owners face forced sales, a different class of assets survives through infrastructural embedding instead of physical productivity. Shares in companies controlling essential networks, such as energy grids or transportation corridors, preserved relative value during the stagflation era because their revenues adjusted with price levels. The underlying mechanism links pricing power to systemic necessity. When an enterprise operates infrastructure that economies cannot easily substitute, it often transfers cost increases downstream. But regulatory oversight can cap that transfer and compress margins during political stress. Contemporary parallels appear in utilities and logistics firms that benefit from index-linked contracts. Still, assuming automatic protection would overlook how technological disruption or policy reform can erode entrenched positions faster than historical averages suggest. A third category derives stability from scarcity encoded in material constraints. Precious metals, particularly gold, appreciated sharply during the 1970s, inflation not because they generated income, but because their supply expanded slowly relative to currency issuance. Scarcity alone, however, does not guarantee preservation. Price volatility in gold markets illustrates that collective belief mediates its role as a store of value, and periods of monetary tightening have historically reversed earlier gains. Digital assets sometimes claim a similar scarcity narrative through algorithmic limits, yet their short history leaves open questions about governance, technological risk, and correlation with speculative cycles that complicate direct comparison with older commodities. Across these examples, a common thread appears in how assets detach from pure monetary denomination. Each category embeds value in either physical output, infrastructural necessity, or constrained supply, but every embedding introduces its own fragilities that surface under stress. What consistently fails first are instruments whose returns depend entirely on fixed nominal promises. During Argentina's repeated currency crises, local bondholders experienced severe real losses because contractual payments remained denominated in units that governments could devalue. The mechanism behind that vulnerability lies in asymmetric flexibility. Issuers of nominal debt often retain policy tools to adjust currency conditions, while holders bear the adjustment through diminished purchasing power. Modern savings accounts share a diluted version of that exposure. Although deposit insurance reduces default risk, it cannot neutralize prolonged real yield compression when inflation exceeds interest rates for extended periods. Current global signals suggest an environment where monetary authorities balance inflation, control against debt, sustainability. Elevated public and private leverage constrains aggressive tightening. Yet persistent price pressures challenge the assumption that cash will reliably maintain real value. Applying the earlier framework reveals a tension between administered currency and embedded assets. Systems attempt to stabilize short-term volatility, but long-duration claims denominated in cash remain sensitive to policy recalibration. Practical understanding emerges from observing how value migrates during these assets tied to real processes or scarce inputs tend to adjust with changing price levels, whereas static nominal claims adjust slowly, if at all. Even this distinction requires caution, because adjustment speed varies widely across contexts. Transaction costs, regulation, and market liquidity can delay the protective mechanisms that theory might predict. Seen through the contract lens, saving becomes an exercise in selecting which agreements with the future appear most durable under shifting rules. No asset offers immunity, yet some structures distribute risk across channels that cash concentrates. The opening scene of the bank queue now reads less as panic and more as a visible endpoint of gradual processes. Individuals line up not simply because money disappears overnight, but because the underlying contract between present savings and future access has already been strained beyond quiet tolerance. Understanding that strain reframes the instinct to hold currency as a search for certainty within an administered system. When that certainty weakens, attention shifts toward assets that negotiate directly with production, infrastructure, or scarcity, even though each negotiation carries its own unresolved conditions. Yet survival is not equivalent to outperformance, and that distinction complicates how assets behave under pressure. In Japan's asset deflation after 1990, real estate preserved nominal presence while delivering decades of stagnant returns. showing that endurance can coexist with long periods of opportunity cost. The mechanism behind that stagnation involved demographic drag and credit contraction working against asset appreciation. When population growth slows and banks restrict lending, even tangible property struggles to translate scarcity into rising real value. Recent aging trends in several advanced economies echo portions of that structure. However, projecting identical outcomes would ignore differences in migration, technology, and fiscal policy that alter how demographic forces transmit into asset prices. Another constraint appears in the interaction between liquidity and stress. During the 2008 financial crisis, assets widely assumed to be protective became difficult to sell without steep discounts, which exposed a hidden dependency on functioning markets. Liquidity operates as an invisible infrastructure supporting valuation. If trading channels narrow, theoretical stores of value can behave like illiquid inventories, preserving worth on paper while failing to provide timely access. Digital trading platforms have since expanded participation and speed. Nevertheless, increased connectivity can synchronize reactions, concentrating selling pressure in moments when diversification was expected to disperse it. These frictions return the analysis to the contract framework introduced earlier. Every asset embeds an assumption about how future exchange will occur, and stress tests that assumption by compressing time and amplifying coordination problems. Historical episodes rarely invalidate the framework outright. Instead, they reveal which clauses in the implicit contract were misunderstood or ignored. From a practical perspective, this suggests that asset selection alone cannot resolve the tension between saving and erosion. Structural resilience depends equally on recognizing the boundaries within which protective mechanisms operate. The investigation, therefore, resists a simple hierarchy of safe choices. What survives tends to do so conditionally, interacting with policy, demographics, and market design in ways that shift over time. Returning to the present environment, persistent inflation combined with high leverage creates a landscape where nominal certainty competes with adaptive assets. Neither side eliminates risk, yet their vulnerabilities arise from different channels. Cash concentrates exposure to policy-managed dilution. Embedded assets distribute exposure across production, scarcity, and liquidity, which can buffer specific shocks while introducing others. Seen in this light, the original impulse to abandon pure cash holdings reflects an attempt to renegotiate the savings contract. Individuals search for arrangements where future access depends less on a single administrative variable. The bank queue from the opening scene no longer represents an isolated emergency. Through the framework developed here, it appears as an extreme manifestation of a universal negotiation between stored effort and evolving systems. What those people confront visibly is a process that often unfolds invisibly in stable periods. Savings migrate toward structures that seem more tightly coupled to real activity, not because they promise certainty, but because they diversify the terms of the contract with the future. The circular image resolves without reassurance. Even when the doors open and transactions resume, the underlying question persists, since every financial system continuously recalibrates how it honors delayed claims. Understanding that recalibration does not eliminate vulnerability. It clarifies why some assets absorb pressure differently than cash, and why survival remains a moving target shaped by the same mechanisms that produced the line outside the bank.